Thanks again, everybody, for joining us this evening for our budget webinar, focusing mainly on payroll items. Do apologise for kicking off a little bit later than expected, but we just wanted to give a couple more people a chance to join on. So, look, I'm going to fire away. The session is being recorded at the moment. I know a couple of people have asked, so we're going to record the session and we're going to share it with the slide decks over the next day or two as well, for anybody who couldn't attend. So today, busy day, I suppose, dubbed as a cost of living budget. Today's announcement stated that this year's budget is to help individuals, families and businesses. And it's also intended to help workers not pay more in taxation due to the rise in inflation. There was a total package of around 11 billion split between, I think, 4 billion for one-off measures and 6.9 billion for budgetary measures. And we're now going to look at some of those changes that have an impact on payroll. I think from the employee side of things, couple of more benefits on the employees. On the employer side of things, from a payroll aspect, there isn't really much on the employer side of things. So some of the topics that we're going to cover here is going to briefly cover national minimum wage and the living wage, although not mentioned specifically in the budget. It was pre-budget. I think it was one of the first measures that we knew that was coming down the track before the budget. We'll cover that briefly. Some of the standard rate cutoff points and credit changes, along with USC changes. Also going to just mention a little bit about some of the kind of core social welfare benefits that have an impact from a payroll perspective. And then lastly, kind of on the budget, we're going to talk about SARP and the small benefit exemption changes. There is a few more topics there, not specifically mentioned in the budget. Some were announced in last year's budget and some have been announced in between, but we're going to look at finishing off with some of the changes that are due to come into play for 2023, like benefit in kind changes for employer provided vehicles, statutory sick pay, and of course auto enrolment, which is 2024. And then we'll finish up with some Q&As. So to begin, first slide I just showed here is National Minimum Wage Act was enacted and kicked off in 2000. And as you can see, each year since 2000, we've had a steady increase towards that so-called living wage. I think the only year was in 2011 when they knocked a euro off, and then quickly a couple of months later they added that euro back on. But overall, we've had a kind of steady increase since the act was enacted in 2000. So big change here on the national minimum wage. For 1st of January 2023, the minimum wage will increase by 80 cents per hour. This is the highest single rate increase since the start of the Act in 2000. I think the previous one was in 2004 when it increased by 65 cents. But on the slide here, you can see the comparative figures between this current year's minimum wage and next year's minimum wage. So that 80-cent increase is going to be realised as 11.30, the minimum wage, and then obviously the thresholds, the percentage thresholds below that, depending on your age, will increase as well in line with that. So we're going from 10.50 as it currently is now today to 11.30 from the 1st of January. Next slide then is just to kind of show for illustration purposes what that might look like. So we've based this slide similar to how government approach it as well, basing it off a single person on national minimum wage and basing it over a 39-hour week. So as you can see here, weekly gross will increase for the employee to 31.20. Obviously, with the tax measures and USC measures that were announced in the budget, there will be obviously an increase because they're getting more, but the net impact on that will be less because of those tax and USC changes, resulting in an increased weekly net pay of 23.57. What that'll look like then, kind of from the employer side of things, employers' PRSI is going to be 11.05%, so that's an increase of 12.66, bringing the overall increase or the total cost to the employer up by 43.86. There's a couple of little caveats that I've put in here, one of them being the assumption that the PRSI credit that's currently in place of €12 will be lost now due to the earnings being over 424. There was no mention in the budget about PRSI, so obviously 424 was in place based on this slide from last year with the gross wage being 410. With the minimum wage increase, it's going to go to 440. So that PRSI credit on the employee should be gone unless we hear anything in the coming weeks about it. We've also increased the USC band, the second rate threshold, so the minimum wage isn't eroded like it has been in previous years. That increase from 21,295 up to 22,920. And we've also based, because we didn't hear much about PRSI changes on the budget, if any, we've also based this on the assumption that the threshold at which the employer's PRSI kicks in from the 8.8% that it currently is today to 11.05%, that banding is not going to increase. It currently sits at 410, and last year it did increase in line with the national minimum wage, but because they didn't mention it on the budget today, we're assuming that it's going to stay at that 410, hence the overall 43.86 extra on the employer side from a cost perspective. So that's just to give you a little overview of what the minimum wage would look like. Next slide then, the living wage. So on the 14th of June of this year, the Taoiseach outlined a proposal to bring in the living wage for all workers and for it to be phased in over a period of 4 years. Living wage is going to be set at 60% of the median wage in any given year. And the national minimum wage is going to remain in place until the living wage becomes mandatory in 2026. So this little graph, although it's not really anything formal, it's for illustration purposes only, and it was released by the low pay commission recommendations on the same day, the 14th of June. But it's just kind of showing what their proposals were back in June, and we can see them being realised now actually to date, that the minimum wage is going up to 11.30. I suppose the big difference is the living wage. It was proposed back in June that might be set at 12.54. It's now currently been set from the 1st of January to 13.10. Standard rate cutoffs. Good to see this one increasing. So at the moment, what they've done is they've increased the single rate cutoff for a single person by 3,200 to bring that up to 40,000. And basically, that just means the entry point at which you go from 20% to 40% is now increased. And those will be increased proportionally for married couples, as well, as you can see there, bringing the combined for married couples to 80,000. And you can see the splits there. Tax credits. There was talk about this maybe being 100, a little over 100. Unfortunately, although it is still an increase, it's a smaller increase than that. But the personal credits, employee PAYE credit, and the earned income tax credit are all getting a €75 increase per annum. The home care tax credit is getting an increase of 100 per annum. And I suppose good news, I think it's bringing in maybe some 400,000 extra renters into the fold from this year, because I think they're bringing it in or backdating it to this year, and also then available from 2023 onwards is the rent tax credit of 500. Now how that's going to be applied, I'm not really sure. I'm going to assume that this year it's going to be applied via my account. So from the 1st of January 2023, if you're filling out a Form 11 or a Form 12, that you'll be able to claim that credit then. In terms of real time claiming that credit from 2023, not really sure how that system is going to work, but I'm just going to treat it the same as the old rent credit that was abolished many years ago, that it's probably something that employees are going to have to claim through their My Account. So although there are small increases to the main ones, the personal and the PAYE credit, there are still increases all the same. USC, standard here really. We've seen it in the last year or two. So no real reductions in USC, but they've increased the USC, the rate 2, the entry point for rate 2. They've increased that again in line with national minimum wage. So that national minimum wage, or 80 cent extra an hour, isn't eroded by USC. So they've uplifted that one, and that'll be effective from the 1st of January. That basically means it's just bringing the current one from 21,295 up to the 22,920. Another good news here is they're going to increase the concession that's in place at the moment for medical card holders with an income that does not exceed 60,000 per annum. They'll remain paying at a maximum rate of 2%, so they don't go into the two higher ones of 4.5% and 8%. So that was announced today. It's going to be extended for a further year until the 31st of December 2023, and then no changes to that additional surcharge for non on PAYE income in excess of 100k, that's still subject to 11. It's the 3% surcharge on the 8%. Some calculations just to kind of summarize the changes in standard rate cutoff, tax credits, and USC. Again, as I mentioned, there wasn't really anything around PRSI. So this slide here just shows a comparative between last year and this year for a single person with an annual salary of 40,000. So you can look through the numbers there to see the changes on tax, PRSI, USC, etc. Big thing is I want to focus on here is just the difference in disposable income compared to this year and next year down at the bottom. So for a single person annual salary of 40,000, the changes that were announced today in the budget will realise an additional disposable income to that person of around about 830 per year. And you can see that split down on a monthly, weekly basis. On to the next slide. Similar calculations on this basis, we've worked it out. Married couple should actually be 2 salary. So apologies for that one, but the first person 50,000, second person in the household earning 35,000. Again, using the same measures that were announced in today's budget with the increases for tax and USC, etc. We can see that their annual disposal income has increased to just over 1,600 per year. And again, that's split down by monthly and weekly. So I think that's good news on the employee side of things with the changes in the budget. A lot more than last year's and again on the previous years. So I'm sure we're all looking forward to those increases from next year on. Social welfare benefits. I've only taken a little snapshot here. There's an awful lot. As I mentioned at the beginning, it was very much, a cost of living budget and focusing very much on one-off measures. I just picked a handful of ones here that are kind of key, I suppose, from a payroll perspective. There obviously is a lot more, but we're not going to cover them on this webinar. But going in line with the announcements in today's budget, we're assuming that the €12 increase on weekly payments is going to apply to all social welfare payments. They have given a detailed list, but we're assuming it's going to apply to these ones. So again, look, compared to last year and this year, we've just applied that €12 increase on it. Nothing really much more to add on that. Might just need to build that into some of our processes and procedures from the 1st of January 2023 when we're looking at maybe how we handle payroll and if company policies are reduce certain pays by social welfares, just to be mindful of those increases. The other thing I just wanted to mention in this slide, everybody should be doing it at this stage, but it's the last one there on parents' leave. It was something that was announced in the budget last year, but it was only taking place mid-year this year, is the change from 5 weeks to 7 weeks. So that 7 weeks has been in play from July 2022 of this year. So just a wee reminder on that one. Some other topics that we have here at the moment, payroll related again, is some good news on SARP, the Special Assignee Relief Programme. So it was announced today that that's going to be extended until the 31st of December 2025. I suppose on the flip of that is they're going to increase the minimum income level for new entrants to 100k. So it currently sits at 75k of relevant income that you need to have to qualify for it. That's going to remain the same for any existing SARP employees, but from next year until it phases out in 2025, that limit's going to increase by 25k to 100k. On the small benefit exemption, another good news story here as well. So it was announced today the small benefit exemption has been increased to a limit of 100,000 of 100,000, I wish, of 1,000. It was previously 500. Another good news story on that one is they've now increased it from 1 benefit per tax year to now 2 benefits that can be given per tax year. And that can be applied from this year on. We don't have to wait until 2023 for that measure to come in. It was announced today that will be applicable for 2022. So maybe something to watch out for in December, I suppose, when the small benefit exemptions are typically applied. Benefit in kind. I wanted to cover this again. This was something that was announced last year. and put into the Finance Act. It wasn't really mentioned this year, especially not in the budget, but it does have some implications and big implications from January 2023. So I thought it'd be wrong if we didn't cover it. So it's just as a little refresher, and hopefully we can give you some takeaways to bring back off this. So just to begin with, the note on the temporary concession that applied for BIK and company cars during COVID-19 ended on the 31st of May 2022. So hopefully everybody was aware of that and made the various changes from the 1st of June in relation to that, reverting back to the normal pre-COVID rates. So these rates below are the applicable rates with effect from the 1st of January 2014 until the end of this year, 31st of December 2020. And it's pretty much based off an OMV at your annual business kilometres. On the next slide, just want to make mention that Section 6 of the Finance Act in 2019 introduced this new method to calculate the cash equivalent for the use of a company car. And these changes are the changes that are coming in from the 1st of January 2023. So some big changes here. Previously, OMV of the car based on annual mileage, we're now bringing in CO2 emissions into the fold as well. So basically what will happen is you'll find out what CO2 emissions the current company car emits. You'll put that into one of the 5 categories A to E, and then you will assess the annual business kilometers, similar as to it works today, to find out. Big difference here is we've got a lot more percentages. And to kind of put it into context, I've highlighted 2 key ones here. So as it stands now today, the lowest rate of benefit in kind is 6%. 1st of January 2023, that's going to increase to 9%. That's a 50% increase on the lowest rate. And I think the highest rate at the moment is 30%, and that's going to increase to 37.5%. They've also announced a flat rate increase on company vans. So currently that's 5%. That's just going to be a flat rate increase to 8% from the 1st of January 2023 as well. So again, some calculations just to give you a feel of what that looks like today compared to 1st of January 2023. So in this example, example 1, we've taken a high emission vehicle. So Volkswagen Passat, OMV of 37k, annual business kilometers of 20,000, CO2 emissions on the logbook 150, which is going to push it into a category, I think it's the 4th category, category D. So as it stands today, and again, these slides are assuming that this particular employee or employees are already fully in the highest rate of tax. So we're just applying the highest rate of tax, worst case scenario here. So as it currently stands, we can see the benefit in kind charge 2022 is 8,880. We can see the associated taxes there and the associated employers' PRSI costs. From next year on, that benefit in kind is going to increase to 12,488. And on the last part of the slide, it just shows the differences between it. So the benefit in kind is going to go up by just a little over 3,600. It's a big change. And along with that, obviously the associated taxes. So what that's basically going to mean in summary, for the employee, their net pay is going to be down by a little over 1,800, and the employer's PRSI cost is going to go up by nearly 400. It's a big difference. And because it was announced over a year ago, just want to recap and keep it on everybody's mind. Next example there, we've shown a low emission vehicle, 50k OMV, 25,000 kilometers, low emissions instead of the previous example, 150. It's 43, category A vehicle. This is kind of where the government are looking to go. They're looking to go low emission electric if possible. So we can see the difference here. Benefit in kind on last year compared to, or on this year compared to next year, it has a better impact on the employees. So they will actually see their net pay increase by around about 390, and on the employer side of things, we're looking at around about €83 of a decrease in employers' PRSI. That just kind of shows you a previous slide to this current slide. That again, as I said, it's very much trying to gear towards low emission and electric alternatives. So last slide in this one is company van. So again, just to show a comparative between the flat rate increase by 3% from 5 to 8. So the net pay is going to decrease by just a little under 470 here for the employee, and the employer's PSI is going to increase by around about 100. Electric vehicles, again, some of these changes were announced in last year's budget, and there was a little bit of confusion around it at the time. A lot of that confusion was kind of clarified throughout this year. So just to kind of recap, as it stands now at the moment, there's no BIK where the OMV of the electric vehicle does not exceed 50k. BIK as normal on the excess over the 50k, so that's as it currently stands today. From next year on, and this is kind of where the confusion lied, it's going to be phased out and kind of reduced over the course of 3 years. A lot of people were thinking it's the 50k exemption that's there at the moment that's going to be tapered down, but it's not. The 50k exemption is going to be abolished in full from the 1st of January 2023, and instead it's going to be replaced by a kind of tapered down credit, if that makes sense. So you will start with the original OMV of the vehicle for 2023, and you will reduce that OMV down by 35k and so on. You'll start with the OMV of that vehicle again for 2024, reduce it by 2010, and then the phased approach will be phased out from 2026. Little example of what that might kind of look like to the employee and the employer year on year. In this example, we've gone with an OMV under 50k with low mileage category A. So we can see here, as it stands currently, because the OMV is less than 50k, no benefit in kind applies to it, because it's under that exemption level. Next year, that exemption level of 50k goes away in full and instead is replaced with that taper down. So next year it brings the 40k down by 35 to leave 5, and so on for the remainder of the years. So the kind of net pay year on year decrease you're looking at from the employee side of things, if you provide them with an electric vehicle, currently as it stands today, no benefit in kind. From next year on that same vehicle, their net pay is going to go down by 585, and then that year on year increase, a further 1700 in the following year, and then a further 1100 in the final year before it gets abolished. So I know I said a minute ago that the big push is towards low emission vehicles and more electric vehicles, but at the same time, the changes in electric vehicles are now going to start applying benefit in kind, which isn't in play as it currently stands. Next slide then, example 2 is just showing one of over 50k with low mileage and a category A. So this is where we're kind of showing currently as it stands in 2022, the full exemption of 50k applies. So we take that off the OMV of 70, benefit in kind applies today on the 20k. Obviously next year 50k disappears, is replaced with the tapered down amount, and you can see that benefit in kind going increasing from 20k to 35 to 50 to 60. Basically same sort of impact as the previous slide. Year on year decrease in employees net pay, we're talking just a little under 1,000, little over 1,700 additional decrease in 2024, and then in the final year before it's abolished, a further 1,100 difference in net pay. Electric van then under 50k, again this is just to kind of show the increase from 5% to 8%. Again, we can see a year on year decrease in employees net pay. Some kind of further considerations, or as I said at the beginning of the BIK slides, just to try and give you with a couple of takeaways. So it may be advisable for employers to carry out costings in advance of the new rules. So again, these rules are coming in from the 1st of January. So you might want to maybe revise some of your current costings in line with those changes. Employers could also inform employees of the extra taxes that may arise. Just want to mute everybody here. Sorry, there was just a bit of interference there. Hopefully you can hear me okay still. So again, employers could inform employees of the extra taxes that may arise from the first pay period in 2023, and then also employers might want to consider their long-term options when purchasing or upgrading company vehicles off the back of the changes that we just covered. Click back on this slide. Lovely. Statutory sick pay. So again, I'm probably more annoyed than maybe most of you are, but I was really annoyed last year when there wasn't really any mention in relation to statutory sick pay, and again, it wasn't really spoken about much in the budget today. So I'm going to try and kind of recap and refresh on last year's slides that we did on the webinar to what we kind of know now. So what we do know now is on the 20th of July 2022, the Sick Leave Act became law. And then on the 14th of September, the Taoiseach confirmed that it will commence the operation of the SSP scheme effective the 1st of January 2023. There was a lot of talk, I suppose, a couple of weeks ago, a couple of months ago, it was going to commence 1st of September. We had a lot of kind of queries about it as well. So thankfully, 2 weeks later, Taoiseach confirmed that on the 14th of September, it will not come into operation until the 1st of January 2023. Same thing applies, we're just pushing it out a year. So once the scheme is commenced, it'll be rolled out over 4 years as follows. So 2023 will kick it off at 3 days. Next year, it'll increase by a further 2 days to 5. 2025 will increase to 7 days, and then it'll become fully operational in 2026 when it's going to be 10 days. So the rate of payment for statutory sick pay, as we know now at the moment, will be set at 70% of the usual daily earnings, capped at 110 per day. And both full-time and part-time employees can avail of paid leave, and this will be in addition to other leave entitlements, including annual leave, parental maternity, and public holidays. So it is extra entitlements to that leave. So there is going to be extra costs on employers or to employers. And all workers will have a right to take a complaint to the WRC where they're not provided with a company sick pay scheme. I just want to sit on this slide for a little second, because there's a little bit of news that kind of come through. Some of it is formalized, some of it isn't formalized. But I think in the last number of weeks there was a spokesperson, can't recall the person's name, but there was a spokesperson from the Department of Enterprise, Trade and Employment that confirmed the SSP will be fully taxable in the same manner as normal earnings, but there's nothing formal as of yet on the department's website. But that spokesperson did say that it would be fully taxable. I know last year's budget and between now and then, we weren't really sure how it was going to work. But take it on this basis that from what the spokesperson said, it will be taxable. The Department of Social Protection are currently kind of working on the practical implications of the upcoming scheme to kind of determine how it will work alongside current illness benefit. But again, details very little on that at present. And the general notes to the scheme that were published back in July 2022 did mention and make reference to the method of the calculation. And what they're doing is, without trying to be too technical, they're taking the same approach or the same method of calculation that's currently there under the Working Time Act determination of pay for holiday regulations. I think it's statutory instrument 475, but it's basically talking about how it applies for kind of like public holiday calculations, fixed rate and variable rate employees. So the normal weekly rate is to include regular bonuses and allowances, which do not vary in relation to the work that's been done, but will exclude any pay for overtime. The big difference, I suppose, between the method of calculation for pay for holidays compared to the sick pay is, instead of using that 13-week average, it's going to be 4-week average. So for those fixed rate guys, it's going to be based on the normal weekly hours last worked before the employee became sick. For those kind of on variable rates of pay, the average is going to be based over a period of 4 weeks ending immediately before the sick leave commences. If no time was worked in those 4 weeks, then you go back over the previous 4 weeks ending on the day which the kind of time was last worked. So similar rules there. It was something that was kind of hidden. The big thing on this one, I suppose, is take it that it's been fully taxed now at the minute, as in the same manner as normal earnings, until we hear otherwise. Another little slide on statutory sick pay is just, I've kind of dubbed this one review, review, review. These are key things and stuff that employers can do between now and its commencement, 1st of January 2023. So in summary, the employer provides a sick leave scheme to employees equal to or more favourable than the terms of this statutory scheme, will not have any additional obligations under the Act. So kind of some of the proposed statutory provisions of the Act are the period of service of an employee required before sick leave is payable, the number of days an employee is absent before sick leave is payable, the period for which that sick leave is payable, the amount of sick leave which is payable, and the reference period for that sick leave. So the kind of Act sets out a couple of conditions which employees can take where employees can take statutory leave. So they must have completed 13 weeks continuous service before availing of SSP. I think this time last year it was mentioned it was 6 months. It's now confirmed that it's 13 weeks continuous service. The employees must provide their employer with a cert from a registered medical practitioner stating that they're unfit to work. I am reading a lot of stuff in relation to this, that although an employee must provide the employer with the cert, that the employer can actually take a stance to either rule that everybody must provide a cert or nobody needs to apply a cert. I think that's still in the hands of the employer. It's at their discretion, but the law clearly states that an employee must provide it. The leave must be taken in relation to days in relation to a day or days where an employee would ordinarily work, and the leave can be taken in consecutive days or non-consecutive days. I suppose the big thing here is review your company policy, sick pay policy, see if it is equal to or more favourable than this. If it isn't, you need to review and make the necessary changes. If it is, then you should be covered. But again, those last kind of few bullet points are little kind of helpers in relation to assessing, is your current statutory sick pay scheme equal to or more favourable. Auto enrollment. I think this might bring us to an end. I wanted to cover this as well. I know auto enrollment is something that's coming in 2024, but I think, again, like budget and most of these changes coming in 2023, I think 2023 will be a big review year in terms of auto enrollment. A lot of stuff is going to happen, although it might happen towards the latter end of 2023. I think, again, from an employer's perspective, it's stuff that you need to kind of factor in from a costing perspective, and maybe review some occupational pension schemes that you may have, or even if you don't have them, that you may need to bring them in. So auto enrollment is set to begin in 2024, and the scheme is kind of being created because there's too few people that have sufficient pension to cover a reasonable standard of living. The auto enrollment scheme, similar to that in the UK, that's been in operation for a number of years now, it is geared more towards the lower earning bracket than the middle to higher earning bracket. So it is very much geared, and we'll see that through as I work through these bullet points, but it is geared towards more of the low paid guys. So some of the key features of the scheme as we know now at the moment, and kind of take this with a grain of salt. I know it is published as this, but again, because we have another year and a few months before it comes in, there could be some tweaks. But look, some of the key features that we know now at the minute, eligible employees will be those aged between 23 and 60, earning over 20k a year, who are not already enrolled in an occupational pension scheme. Those earning less than 20k can elect to opt in, kind of similar to UK. So once you're in that age bracket earning over 20k, your employer is going to have to automatically assess you as being eligible. Pension will kick in. Anybody under 20k can elect to opt in. So the scheme will operate on an opt-out basis. And again, this is to kind of encourage people into the scheme and hoping that people won't opt out. Whereas if they did it in an opt-in basis, I don't know, you might kind of think nobody's going to opt into it. So it is going to operate on an opt-out basis. And as it currently stands, the opt-out basis isn't going to be able to be actioned by the employee until after 6 months of being opted in. So what that'll basically mean is, if you're one of those eligible employees and your employer needs to start deducting this and paying over their contributions. That's going to happen from day one for a period of 6 months. And then you will have the next 2 months, month 7 and month 8, as an employee to opt out of the scheme. But it is on an opt-out basis. Employees can suspend their contributions at any time outside these defined periods, but I think that suspension or opt-out is, I can't recall exactly when that's going to stop. I think it might be when the scheme is fully operational, or it might happen, you know, sometime within the 4-year period. But I think that suspension and kind of opt-out rules that are there to begin with might go as we become more years into the scheme. So employees who have opted out or suspended, again, will be automatically re-enrolled after 2 years. So again, this is similar to the UK. I think the UK do automatic enrolment every 3 years on the anniversary of your staging date. In Ireland, it's proposed that they're going to be re-enrolled after 2 years. So employers will have to carry out that same assessment and the admin that comes with that to re-enroll everybody again after 2 years. Employees who are existing members of an occupational pension scheme will not be assessed for AE. The AE pension will be implemented on a pot follows members basis, meaning that the employee will benefit from owning one single auto-enrolled pension pot across their working lives. So instead of like occupational pension schemes where you may have several of them, and then you might have to go about, you know, as you maybe leave jobs, how you go about carrying that fund over, do you amalgamate them into other ones, etc. This will be a pot follows members basis, so the employee will own it and they'll be able to, it's theirs, they'll have one single one and they're able to easily carry it from employment to employment. At the moment, it's proposed that there'll be 4 separate investment funds that will be set up to administer the AE pension schemes. One of them will be a well-balanced default fund, and the other 3 will kind of carry different levels of risk. I think as it stands now at the moment, we're being told if the employee doesn't choose, they will go into the well-balanced default scheme. If they decide and put in which scheme, then they'll have the choice of 4. And the scheme will be phased in over 10 years, with contribution rates increasing every 3 years. So on the next slide, I think it might be the final one, is just kind of showing what some of those costs or percentages will be between 2024 and 2034 over the 10 years, and some of the timelines. So what we're looking at here is years 1 to 3, we will see employees have a 1.5% percentage set to them and a matching one for the employer of 1.5%. And then the state will contribute 0.5%. They will then increase over time, as we see in the next 3-year cycle, 4 and 6, they'll increase 3, 3, 1, and so on and so on. When it becomes fully operational after year 10, those percentages are proposed that they'll sit at 6 employee, 6 employer, 2% state. The employer contributions and the state contributions will be capped at a maximum of 80k of an employee's gross earnings, and the employees may contribute on earnings greater than 80k if they wish. 1 or 2 little things that I want to kind of talk about and cover here is mainly around occupational pension schemes and I suppose the auto enrollment scheme. So kind of different to occupational pension schemes, the auto enrollment scheme is not going to have any tax relief. There is going to be no tax relief from the employee for putting into a pension. Instead, that's been replaced with the state contribution, those 0.5%, 1%, 1.5%, and 2%. Again, what I mentioned earlier about it being geared more towards the lower paid guys. If the lower paid guys were in an occupational pension scheme, let's assume they're lower paid, they're in the 20% bracket, they will get 20% relief. The auto enrollment, if an occupational scheme isn't available to them, under the auto enrollment scheme, although the full amount is coming off their net pay, because of the state contribution and the level it's set to, it's actually going to realise a 33.33% saving to the employee. So it is actually more beneficial, even though it's going to be deducted off the net pay, similar to the UK, where they operate a tax relief at source scheme, where 80% of it comes off net pay and the pension provider pays the 20% over. This one is going to work on a similar sort of basis. The only difference is no 20% relief replaced with a state pension for low paid earners. That's going to realize an increase in tax savings, because it'll be that 33% extra. Who it won't benefit are those in the higher paid that currently get 40%. That 40% won't be applied. The same 33.33% will apply. But I suppose the logic behind this is more middle to higher paid earners are probably in some sort of an occupational pension scheme anyway, and therefore getting the benefit of the 40%. And then some timelines, just on when at present they're proposing. The big one, I suppose, is the CPA. These are the guys that are going to administer it. Work on that has already commenced. And then I suppose the big ones then are, as I said at the beginning, the latter end of next year, kind of Q3, Q4. So that's when the legislation is going to be enacted, the completion and the development of the IT system that's going to be able to that's going to be able to administer this and allow employers or payroll providers to be able to submit this information to the CPA. And then obviously the commencement of automatic enrolment from Q1 2024. One last point before I finish and go to the Q&A is around, if you think about the statutory sick pay, government have kind of announced and put that wording into it must be equal to or more favourable than current sick pay policies. Again, it doesn't say it in terms of auto enrolment, but nice little thing to kind of think about here is, I don't know if that same logic is going to apply to occupational pension schemes. So they do say if an employee is in an occupational pension scheme, automatic enrolment won't apply. But I'm taking the basis that, I don't know, let's say typical occupational pension schemes might be a 5 and 5%, a 1-for-1 scheme, 5% employee, 5% employer. I know, look, 10 years is a long time away, anything can happen, but in 10 years' time, the auto enrolment percentages are going to go to 6 and 6 with a 2% state. So I don't know if there's going to be changes to this that are going to kind of go, well, you know, it needs to be equal to or more favourable than occupational pension schemes. So at the moment, it's saying if you have an occupational and your employees are in that, you're fine. You're covered. Auto enrolment won't kick in. But as you can see, as the percentages start to increase, will they put some caveat in that? Food for thought. It's 10 years away. Today was more focused about today and 2023, but it just gives a little bit, I suppose, for employers, etc., to kind of think about next year. That's it from the presentation today, guys. So I'll just give one last we shout out to see if anybody wants to come on for a question or go back and finish those glasses of wine or whatever you are having.
I think we'll leave it at that, Niall. And as Niall said, the webinar is being recorded. We'll get the slides over to you as well. And if you have any questions, as Niall said, his contact's there, the office number is there. Please feel free to give us a call. The entire team's there to answer any questions that you have. Please feel free to reach out.
Perfect. On that note then, guys, we'll leave it at that. Thanks very much for taking your time out of your evenings to listen to us, and we'll share the relevant stuff over the next couple of days.